Hey, I'm Jonathan Wild, and we cover how to account for stock splits. A stock split is when the board of directors call in the corporation's outstanding shares and issue new shares in exchange for each old share. For example, if a corporation did a 5-for-1 stock split, an investor who previously owned 10 shares would now receive 15 new shares in return for the old 10 shares. Now you might be asking yourself, what is the benefit of doing a stock split? Companies might do these splits when they feel their stock price is getting too expensive for people to buy. Like let's say a corporation stock price is $1,000 and the corporation does a 5-for-1 stock split. In theory, after the split, the value of each share should be $200 each. Now let's talk about how to account for these splits. Assume a corporation has 10,000 shares outstanding of $5 par value common stock, and the company does a 5-for-1 stock split. After the split, the corporation now reports 50,000 shares of $1 par value stock. This stock split does not affect total equity. The only change is to the common stock account title and the description of shares issued and outstanding on the balance sheet.